3 years ago, and we started with the view that we would like to bring the contemporary issues, policy making, to the attention of the policymakers and discuss it among scholars within the country and across the world. We've been very, very fortunate in having a very good blend of researchers, scholars, academicians from within the country and across the world to come and talk about contemporary issues. Once we once we started this journey on these contemporary issues, we were surprised how there's a convergence of issues globally and domestically. And that was extremely encouraging because we could learn from the experience of various other countries. It's 3 years. We've done about 180 webinars. We have had the privilege of hosting two Nobel laureates, and I think many more potential Nobel laureates that have come on our forum. And we have discussed issues across the spectrum. We were very fortunate, thanks to Professor Ashima. We did a series for the G20 11 webinars under Task Force 5. And now we are working on a related issue on empowering women. With this series that we have done, we feel that we have brought to the policymakers in our country a global approach as well as an analytical approach towards various issues that we have been discussing. We have been discussing about geopolitics, we have been discussing about climate, about finance, and of course, economic issues. To chair the session today, we have invited Professor Ashima Goyal, who's advisor at EGROW. I'll just briefly introduce her, and then our main speaker for the day is Dr. Ayhan Kose, and Professor Ashima, would be introducing him before he makes his presentation. Professor Goyal has been with IGIDR for a very long time. He has provided consultancy to ADB, DEA, GDN, UNDP, RBI, UN Escape, and the World Bank. I would say she is most active in the Indian policy debate and has served on various government committees, including the Economic Advisory Council to the Prime Minister and the RBI Technical Advisory Committee for Monetary Policy, and has been on the boards of educational and of financial institutions. She serves, even now, as member of RBI's Monetary Policy Committee. She edits a Rowley journal in macroeconomics and finance and contributes a monthly column to the Hindu Business Line. She was a visiting fellow at the Economic Growth Center, Yale University, a Fulbright Senior Research Fellow at Claremont Graduate University. Her research has received national and international awards. She won 2 Best Research Awards at GDN meetings at Tokyo and Rio de Janeiro, was elected as one of the 4 most powerful women in economics, a thought leader by Business Today, was the first Professor P.R. Brahmananda Memorial Research Grant awardee for a study on history of monetary policy in India since independence, which was published by Springer later in 2014, received the Scott Challenger Award for Economic Policy in 2017, and the Distinguished Alumni Award at the Hindu College. Professor Goyal is widely published in institutional and open economy macroeconomics, international finance, and governance, with more than 100 articles in national and international journals. She has also authored and edited a number of books, including Macroeconomics and Markets in Developing and Emerging Economies, and a concise handbook of the Indian economy in the 21st century. With this, I invite Professor Ashima Goyal to chair this session today. Professor.
Thank you, Charan. Thank you for the invitation and for all that EGROW is doing. Can you hear me clearly?
Yes, we can.
It is, yes.
So I'm it's my pleasure to welcome Dr. Ayhan Kose, who is extremely erudite and learned and working in areas that where there's so much uncertainty surrounding us. We really want to know. So he's going to be talking about, I think, growth prospects. And he's very well suited to be doing that since he's the Deputy Chief Economist of the World Bank Group and Director of the Prospects Group. He's a member of the Chief Economist leadership team overseeing the bank's analytical work, and he leads its work on the global macroeconomic outlook, financial flows, and commodity markets. And he's also responsible overall for the bank's flagship global economic prospects and commodity markets outlook, in addition to other publications. Before joining the World Bank, he was with the IMF. He's also done extensive research in macroeconomics and finance and published in leading academic journals, including American Economic Review, Journal of Monetary Economics, Journal of Development Economics. And he has a wonderful book, Falling Long-Term Growth Prospects. So we look forward to listening to him.
Thank you, Ashima, and thank you, Sharon, for inviting me. I wish I could be in Delhi interacting with you all. I know there's a lot of traffic in India nowadays. Lots of dignitaries coming for the G20 meetings. And so far, so good. I think the G20 process has been going well, and India has been extremely successful, elevating some important issues from the perspective of developing economies to the global stage. I'm very appreciative of Sharan's invitation. For those of you who do not know, Sharan and I, of course, worked together in the IMF for an extended period of time, and we established this very nice friendship. He used to visit Washington, D.C. At the you know, that kind of this we had this IMF annual research conference, but sometimes annual meetings, spring meetings as well. I'm hoping that he's going to start that tradition sooner than later. If that doesn't happen, I'm going to come and visit him in India. So today I am going to talk about global economic prospects based on our latest report on the topic. What I plan to do, I plan to show you some slides, and then we can basically discuss the questions. As Ashima mentioned, there is significant uncertainty ahead of us. And of course, when we think about the global economy, the types of growth numbers we see around the world, not in India, quite concerning. What I plan to do is to tell you how in the World Bank we assess the kind of the where we are in the business cycle and how we see things are developing. Let me share my slides. Can you see it? Okay, good. So the World Bank releases Global Economic Prospects report in January and June. This report has just a little bit of coverage of advanced economies, but really mostly about emerging market and developing economies. In the latest report, we have the usual monitoring chapters, the global outlook and the regional outlooks. In addition, in every report, we have analytical chapters. In this latest report, we look at two topical issues: financial spillovers of rising US interest rates, and the other one, fiscal policy challenges in low-income countries. I'm going to focus on three specific questions just to structure our conversation. The first question is, what are near-term prospects for the global economy? In a nutshell, global economy is experiencing a sharp slowdown. And when we look at the kind of the near-term prospects, there are significant downside risks. And I think the most important one now is an intensification of financial stress. The second question I want to focus on today, what are the main fiscal policy challenges in low-income countries? This is something G20 is already looking at thanks to India's leadership. A wide range of challenges are there, rising debt, rising interest payments, increasing fiscal deficits. In an environment, you have persistent revenue weakness and, of course, substantial spending pressures. Ultimately, what happens is that limited fiscal space for support and investments impedes overall development and climate-related objectives in these economies. And finally, what are the main policy priorities? There are certain things we are expecting policymakers to do at the national level, and we are expecting, global policymakers to, at global fora like G20, G7, to ensure financial and macroeconomic stability, and basically over a longer time period, increase growth prospects, address the climate change, and have a sustainable, equitable development path. Throughout the presentations, I'm going to use these two acronyms, EMDEs, Emerging Market Developing Economies, and LICs, Low-Income Countries. So let me start with the first question. What are near-term prospects for the global economy? This is a rather crowded table, but I suggest you to focus on only those numbers circled in dashed red lines. So global growth is expected to slow substantially in 2023, primarily because of the continued monetary policy tightening to slow down high inflation. And of course, that comes with restrictive credit conditions. We are expecting growth at the global level to slow down 3.1% last year to 2.1% this year. A little bit of pickup next year, around 2.4%. But I'm going to put these numbers in historical context. That number is not, of course, good enough. When we put our January report, we thought that we would see a sharper slowdown this year, but there was quite a bit of resilience, especially in major economies. But going forward, we believe that this resilience is going to fade, and we will see more the impact of policy tightening in advanced economies around the world. So what happened is that as much as this year's numbers upgraded a little bit, next year's number downgraded the significantly around 0.3 percentage points. So turning to advanced economies, there we expect actually growth really slow significantly from 2.6% to 0.7%. And then next year there's a little bit of pickup. But advanced economies have this very serious inflation challenge that require them to tighten monetary policy in the US, Euro area, UK, and the combined impact of these significant interest rate increases will really be felt this year, and of course some of it next year. In the case of emerging market developing economies, there is a little bit of pickup from 3.7% last year to 4% this year. But that pickup is mainly driven by China. China had a rather weak growth outcome last year, but this year, because of the opening, there is momentum. Even though in the case of China, there has been a slowdown in recent months. But overall, we think that China can get close to, if not more, 5% growth this year. When you take out China from the sample, of course, what happens is that you see a significant slowdown in emerging market developing economies from around 4% to less than 3%. And when you look at the global economy, advanced economies, and emerging market developing economies, we pretty much downgraded our forecast for next year. So briefly, what do these numbers mean when you look at, what type of growth global economy delivered prior to the pandemic? And here I have the averages over the period 2010-19. You see on the left column, and then of course the 2023 numbers. You also have 2024 numbers. And the bottom line is that this year and next year, okay, it's not just this year and next year, we are expecting the global economy, emerging developing economies, advanced economies, whether you include China, exclude China, it doesn't matter, growth will be lower than what the global economy delivered, advanced economies delivered, emerging developing economies delivered over the 2010-19 period on average. So prior to the pandemic, the average growth was around 3%. This year and next year, it's going to be around 2.3, 2.1%. Advanced economy growth will be much lower relative to the, what we saw prior to the pandemic. And emerging market developing economies as well will see a significant growth slowdown. Now, going forward, when we look at the individual regions, in the case of East Asia and Pacific, there is growth acceleration. As I mentioned, that is mostly driven by China. And then if you look at South Asia region, growth is pretty much stable. And in the case of South Asia, of course, growth will be that region will deliver the highest growth among all these emerging market developing economy regions. And there, the resilience of India is critical. But when you look at other regions, for example, Sub-Saharan Africa, Latin America and the Caribbean, Middle East and North Africa, growth is going to slow from last year to this year and will basically remain somewhat mediocre next year. In the case of Europe and Central Asia, because of Russian invasion of Ukraine, there is a significant impact, and that impact manifests itself. Growth is close to 1%. So, what did I say? I said, what did I say? I summarize here. With respect to near-term growth prospects, global economy slowing and slowing sharply. And you see it here, how growth slowed from 2021 to 2023. You also see it here, this line, 2010-19 average. Basically, whether you look at the world, advanced economies, EMDEs, emerging developing economies, excluding China, growth performance will be weaker than what we saw prior to the pandemic. And then if you look at basically the regions, the picture is pretty much same. You see growth slowing in most of the regions. In the case of South Asia region, the growth is stable, and growth basically performance is weaker than what we saw prior to the pandemic. So let me spend a bit more time explaining these numbers and what they mean in general. Here, this year, the left panel shows that the weakness we are projecting is widespread, especially in the case of advanced economies. Advanced economy growth slowing sharply. Now, we basically looked at which countries contributing more to global growth, given the kind of the weakness we are observing in the global economy, relative to, you know, how they contributed prior to the pandemic. So over the period 2010-19, the contribution of US and Euro area combined was around 23% to global growth. This year, that number is going to be below 20%. If you combine China and India's contribution, that's going to increase from point around 40% to 57%. So these two large emerging market economies going to contribute much more than how much they contributed prior to the pandemic. In the middle chart, you see that how monetary policy tightening affected our forecast revisions for this year. In advanced economies, as well as emerging market developing economies, we downgraded our forecast more in economies that tightened their monetary policies more. You might say, is this surprising? No, but in the case of course, advanced economies, you see how there has been significant difference. In other words, the impact of monetary policy tightening is already there in growth numbers. Another big observation with respect to growth forecasts for this year is how countries that are more vulnerable to financial shocks ended up seeing much weaker growth outcomes. So in the right panel, you see our June 2022 forecast for countries with different credit ratings. These are all emerging developing economies. And in fact, those countries with lower credit ratings ended up performing much worse than what we basically projected a year ago. In other words, at the global level, monetary policy tightening is having an impact, especially on those emerging developing economies with lower credit ratings. So I also want to talk a little bit about the growth, basically projections we have over a period of time, and compare that what type of growth emerging developing economies delivered in the past. So when you look at the figure on the left, what you see is 5-year growth averages from 1990 to 2020. So that red bar is the growth performance over the period 2020-24 average. And as you see, the average growth over this period 2020-24 will be the lowest average growth for emerging market developing economies for any non-overlapping 5-year period since the early 1990s. You might say, oh, isn't this because of the pandemic? The answer is no. Here you have, of course, the global financial crisis. You have Asian financial crisis. You have 2001 global slowdown. You have euro area debt crisis. So there were a number of shocks actually buffeting these economies. Another important point, when you look at GDP per capita in 2024, for around 30% of emerging market developing economies, GDP per capita by the end of next year will still be lower than what it was in 2019. In other words, these economies are not going to truly recover from the pandemic. If you use this metric as one way of thinking about recovering from the pandemic, they are not going to go back to pre-pandemic per capita income levels. What is worrying us ultimately whether emerging market developing economies are getting close to per capita income levels of advanced economies. As you see on the right panel, in general, there is a very serious problem in low-income countries. And if you take out, China from the emerging market developing economy sample, those countries' ability to converge advanced economy per capita income levels. Later, I'm going to talk about these low-income countries' fiscal challenges. But as you see on this right panel, their relative income to the income levels of advanced economies hovering around less than 2%. And that hasn't changed much over the past 2 decades. Against this background, we see multiple downside risks. Of course, some of these risks we know very well. Financial stress that could be triggered by problems in the banking sector, that could be triggered by a sudden stop episode in an emerging market economy. In an environment, you have basically higher interest rates and weaker growth. We might end up seeing further monetary policy tightening. In the US, there is this possibility that a tightening cycle is coming to an end, maybe 1 more or 2 more interest rate increases if inflation gets into this sustained decline. But that's not guaranteed either. Early this year, there was the hope that, inflation prospects are getting better, but that did not materialize. In the euro area and in some other major advanced economies, inflation remains a serious challenge, and policymakers need to basically continue tighten monetary policy. In addition to these financial stress-related risks, there is, of course, geopolitical stress that translates into energy and food insecurity. And whenever you have this type of price pressures and weak income prospects, you worry about possibility of social tensions. Climate-related disasters is on the rise. I'm going to talk about that. We are also worried about these weaker long-term growth prospects. And on this issue, we released a major study in March. I invite all of you to check it about the kind of the how the bank thinks potential growth down the road. Fragmentation of global economic networks has already started, and that has significant consequences for the ability of the global economy to generate growth down the road. Let me briefly talk about the inflation and monetary policy challenges. Here on the left, you see our views with respect to global inflation. Persistently elevated global inflation remains a key policy challenge. Commodity prices, most of them have been declining. And supply chain related price pressures have been, moderating. Against this background, we are expecting actually headline inflation to come down over the next 18 months at the global level, and you see that in the left panel. However, we also expect that inflation to remain above its pre-pandemic level for the foreseeable future. So by the end of next year, we are expecting inflation to be around 3.4, 3.5% after registering, 8.5% the peak last year. So the big challenge is that as much as headline inflation is coming down, core inflation that excludes food and energy prices, remains persistently elevated. And this is driven by services inflation, of course, tight labor markets, and the pass-through of earlier increases in energy costs into broader prices. You see that in the center panel. Even there, the disinflation process has started, and there are some good news from the US economy. The question is that whether those good news will continue in coming months and change the policy stance of the policy makers. But the bottom line is that even if tightening cycles come to an end, it is clear we are not going to see immediate decline in interest rates unless we basically see persistent trend decline in inflation towards inflation targets. Now, on the right, you see how this interest rate tightening cycle compares with previous episodes. And the current hiking cycle in the United States is the steepest and fastest one, this red line, in nearly 4 decades, reflecting inflation outcomes not seen since the early 1980s. In one of the chapters in the Global Economic Prospects Report, we look at the spillovers associated with these interest rate increases in the United States. Here, as shown in the left panel, the current hiking cycle is not only the steepest and fastest in nearly 4 decades, but also the underlying drivers of this hiking cycle different from all cycles since the mid-1980s, and the resulting movement in these 2-year US Treasury yields. In previous cycles, we saw prominently a reaction by the Fed to expectations of firming economic activity. In other words, there was this real sector getting basically accelerating. The economy is showing signs of overheating, and the Fed is responding to that. The current hiking cycle, however, is mainly driven by market participants' reassessment of how the Fed is going to react as it pivots toward more hawkish policy stance to reduce inflationary pressures, which we call reaction shocks. So the Fed is just purely targeting inflationary pressures and thinking about how to reduce inflation. And these types of reaction shocks tend to have a significant impact on emerging market developing economies. And you see that in the middle panel, especially for frontier markets, 10-year yields and their spreads respond significantly in response to these types of reaction shocks. And in the case of course, sovereign spreads, what happened is that over time, the rapid tightening of global financial conditions has been accompanied by a surge in the number of emerging market developing economies, with sovereign spreads exceeding 10 percentage points. And you see on the right how this has been affecting now more than 30% of emerging market developing economies. So when you think about the having access to the kind of the financial markets with this type of spreads, more than 10 percentage points, you are pretty much paying an extraordinary cost to have access to financing, or financing is becoming prohibitively expensive. In the latest report, we look at two scenarios that focus on realization of financial stress shocks. Now, these scenarios look at what will happen if global financing conditions tighten. And in one case, this global financing conditions tighten, but pretty much financial stress is contained within advanced economies. But in another case, we look at in the other scenario, the financing conditions also tighten for emerging market developing economies. When this type of the risks materializes, you end up with much weaker growth outcomes. In the first scenario, for example, the financial stress translates into a severe credit crunch that remains largely contained in advanced economies. Global growth declines to 1.3%. Then, of course, what we projected in the baseline, 2.4%. In the second scenario, this stress spreads to emerging market developing economies, and the global growth goes down to 0.6%. And that's, of course, consistent with a contraction in per capita global GDP. That means you are having a very serious episode in terms of a global recession. So the growth in emerging market developing economies also declines significantly. Let me turn to the second question. What are the main fiscal policy challenges in low-income countries? So when you look at low-income countries and compare them lower middle-income countries, in 2011, their debt levels were pretty much same relative to their GDP, around 30%. But you come to 2022, government debt rose significantly and went up to 67% in low-income countries. In lower middle-income countries also went up, but just by 22%. So low-income economies ended up accumulating debt at a much faster pace than lower middle-income economies. With this, government's net interest payments relative to government revenues increased significantly. That number was less than 5% in 2010. Now it is above 10%. So they are allocating a big chunk of revenues just to basically pay these net interest rate cost. Of course, from 2011 to 2022, a big chunk of low-income countries, close to 90%, saw their primary balances deteriorated. In other emerging market developing countries, that number was around slightly above 50%. I'm going to quickly talk about the spending and revenue pressures we see in these economies. Here on the left, you see the contributions to primary balance changes. I mentioned there has been a significant deterioration. And there, the big problem is on the expenditure side, not the revenue side. There you have this significant, basically, increase in expenditures relative to not much of a change in revenues. And you see in the middle panel, revenues relative to GDP in these economies hasn't been moving much. So we always talk about, fiscal revenue mobilization, and there has been quite a bit of push for that, but that has not translated into a significant increase revenue to GDP ratios. And when you look at the kind of the tax revenues, especially the goods and services taxes, personal income tax, corporate income taxes, direct taxes and indirect taxes, low-income countries still collect significantly lower amount relative to their GDPs than other emerging market developing economies. So there are significantly increasing spending pressures. There is chronic revenue weakness, and that revenue weakness manifests itself in indirect taxes as well as direct taxes. Now, on the expenditure side, you see that expenditures actually increase over time relative to GDP. So you did not increase your revenues, you increased your expenditures. At the same time, of course, something has to give. And over a period of time, when you look at amount allocated for education and health, these economies now allocating a much smaller fraction of their GDPs for education and health expenditures than other emerging market developing economies. Another important finding we have, how weak spending efficiency in low-income countries relative to other emerging market developing economies. In a nutshell, these economies have significant chronic fiscal challenges, and those fiscal challenges led to the problem of basically recent unsustainable debt dynamics. Let me conclude with a few messages on the policy priorities. No question, there is a wide range of global challenges. One important challenge is the climate change. And the impact of climate change in the context of low-income countries already become very, very serious. In the left panel, you see a fraction of population under natural disasters in low-income countries. When you control for population, the average low-income country experiences more natural disasters in a year than the average emerging market developing economy. At the same time, the percentage of population affected by natural disasters in these economies has increased sharply, especially among countries in fragile and conflict situations, compounding the development challenges in these economies. Much of the increase in the share of population affected by droughts in recent years is driven by severe droughts in fragile low-income countries in the Sahel region. These are like the Burkina Faso, Central African Republic, Ethiopia, Somalia, South Sudan, Sudan. So the temperatures in the Sahel are expected to increase 1.5 times faster than the global average, leading to more frequent adverse weather events, such as droughts and irregular rainfall. And I think the figure on the left shows you the extent of the problem. Relative to 2019, you didn't have, a big chunk of population under natural disaster. And then you come to 2022, now 20% of population nearly subject to effects of the natural disasters. Another important global challenge is, of course, the debt. I already talked about the rapid debt buildup in low-income countries. Low-income country debt, as you see in the middle panel, has also shifted in composition toward riskier sources of financing. Non-Paris Club creditors, especially China, have become a more important source of financing over the past decade. Since 2011, the non-concessional share of government debt has risen in the average league by almost half to 55% in 2020. Increased exposure to commercial creditors, of course, creating a big coordination challenge for debt resolution, and we see those challenges nowadays. In the right chart, you see one manifestation of fragmentation. Generating growth around the world requires basically the cross-border trade flourishing. But trade restricting measures, the number of those measures has increased exponentially since 2009 relative to trade liberalizing measures. Of course, this is not the type of outcome we would like to see when we think about trade as an engine of growth. The report has an extensive menu of policy messages. Implementing policies at global and national levels, thinking that a number of problems are basically global challenges. In the near term, the single most important challenge is the financial stress risk, and of course these debt problems in emerging developing economies, especially in low-income countries. And their policymakers need to employ, interventions that are transparent, consistent, and credible. They need to cooperate better to reduce food insecurity and, tackle climate change and increase the speed of energy transition. There is quite a bit of debate with respect to fragmentation. What we learned over a long period of time, one of the most important global public goods is the rule-based international order. We need to protect that order and we need to strengthen it. It is basically like institutions or legal system or justice. All countries need international order that is rules-based. Now, on the monetary and financial policy side, I have already discussed the challenges. For advanced economies, inflation is still #1 threat. But when they employ these policies, they need to take into account cross-border effects of these policies. On the fiscal policy side, fiscal policy needs to be complementary to monetary policy and needs to be really targeted, thinking about the consequences of fiscal, expenditures when we discuss these serious inflation problems, as well as in a number of emerging developing economies' debt sustainability challenges. Beyond near term, I talk about how growth this year, next year, and you know for the foreseeable future is going to be weaker than what we delivered in 2010s, and we were not happy about the growth global economy delivered in 2010. So we need to find ways to improve growth prospects. There are some opportunities, especially in the context of climate-related challenges. The climate issue requires an investment surge. That surge could translate into more investment, more infrastructure, green infrastructure, and more jobs. Of course, that type of surge needs to require intelligent fiscal policy, thinking about the efficiency at every level. Let me quickly summarize. I discussed 3 questions today. The first one, what are near-term prospects for the global economy? There is no question. Global economy is slowing and slowing at a rapid pace. And I think there is no question that we are facing multiple risks. The baseline I told is one outcome, but I also talked about these risk scenarios we have that could lead to weaker growth. The second question I discussed, what are the main fiscal policy challenges in low-income countries? For these economies, unfortunately, the bill of fiscal richness, the profligacy, has arrived. The chronic problems now translated into unsustainable debt problems, and that has huge implications for these economies. The third question, what are the policy priorities? There, the national policymakers can do certain things, but those efforts will not be sufficient. We need to find ways at the global level to address common problems like climate change, like food insecurity and energy insecurity, and we need to think about the role of rule-based international order. The bank, the Prospects Group, has been discussing these issues for a period of time. I invite all of you to visit our webpage and look at our studies with respect to growth, informality, commodity markets, productivity, inflation, debt issues. In April, we released our commodity markets outlook. In October, we will release another one. And we have a number of studies looking at the cyclical challenges as well as growth challenges confronting the global economy. Once again, I would like to thank EGROW Foundation for inviting me, and I look forward to the exchange. Thank you.
Thank you. Thank you. That was an excellent presentation with possible solutions. But I have a number of questions. Maybe I will commence. I will start with that and then open it to the floor. So, recently, just today, I think I was reading an article, an interview by Professor Rubini, and he's known as Mr. Doom and Gloom. But he seems to feel, for the first time, I'm seeing he's relatively optimistic. He seems to feel that the soft landing is more likely, is the likeliest of the different scenarios. And we've seen, as you remarked, that during 2022, the world has done better. US has remained strong. The economy has remained strong despite a lot of tightening. And Europe has done better than expected despite the war, and so on. So why do you think this will not continue in 23? And you seem to largely put that monetary tightening and its effects. But monetary tightening, we are seeing that inflation is coming down in the US. Very recent numbers also show that. In India, we've seen inflation come down below our target, towards our target, below into the tolerance band. Core inflation is also softening. And I think monetary policy seems to be becoming more data-based. Instead of saying that we will that you need to raise rates in order to prevent inflation rising in future. When you look at the rates in terms of the real rates, in terms of inflation expectations 1 year ahead, then I think those are pretty high in the US, and they seem to be bringing inflation down. So, and the main spillovers to the rest of the world is very interesting tightening or rise in spreads, global sovereign yields around different EMDEs and LICs that you saw. Now here I would like to again talk about the two. One is that this is a global shock, right? And then the global international financial architecture should have answers to this. A lot of this spiking in yields comes because of surges, outflows of foreign capital from these countries, or expectations that it will go or the currency will depreciate. So don't we need some kind of global safety net? As we saw those growth rates for emerging markets, also EMDEs, LICs, growth was much lower in 2010s compared to 2000s, that decade. And this is when the shock started, the GFC, then the Euro debt crisis. But we've had no kind of safety net for emerging and developing economies. And they've had to tackle this. And so a lot of them have gone towards self-insurance. In India, for example, we have large reserves, we have capital flow management, we don't have full capital account convertibility. And you know, if you look at the South Asian region, then compared to, say, Sri Lanka or Bangladesh, where they relied on China and got highly indebted and their reserves were not adequate. So they are really in trouble, while India built up its reserves and has been able to intervene and actually run our monetary policy, fiscal policy independent of the US and had smooth shocks, which has helped sustain growth. But it's costly to be, and only a large country can do that. Otherwise, you need some global solutions, you know. So what are potential, say, like central bank swaps or liquidity to counter outflow of foreign capital? And also because, you know, as I said earlier, these LICs are not systemic, but if you take LICs and EMDEs together, now they account for more than 50% of global growth. So the feedback to the advanced economies also is very large. And therefore, it should be in their own interest to design a better international financial architecture where you can moderate these shocks and help sustain growth in the world as a whole. And again, as you said, I think climate change gives an opportunity because it's the poorest countries that suffer the most droughts and other climate shocks. And if help can be designed, you know, at lower costs. So some ways, I think the IFA can really reduce the cost because the cost of borrowing is the highest for these countries. So some sort of de-risking of loans so that more private capital, public capital. I think the World Bank can do a lot in this, you know, to de-risk, to reduce the cost of loans to private capital going into these LICs. Yeah, thank you. So if you want to take up some of these issues or collect more questions.
Let me quickly react to these comments. Thank you, Ashima. Before collecting questions from the floor, I see a number of requests for the presentation. I will share the presentation with you, and it can be posted on the web page. Now, your first question about these, you know, this issue, soft landing versus hard landing. Obviously, our baseline scenario is about soft landing. We do not see an annual contraction in any advanced economy. Now, we have a hard landing scenario as a risk, and I talked about that. from our perspective, this discussion with respect to soft landing versus hard landing, not necessarily informative, because even under soft landing, growth we will see this year and next year will be much weaker than the average growth we saw in 2010s. Obviously, we are a development institution, and growth is critical to make progress on development objectives. There are different ways of looking at outcomes, but we cannot be happy if 30% of emerging developing economies per capita income still, by the end of 2024, lower than what they had prior to the pandemic. So this big challenge with respect to growth weakness is something we need to focus on, and that will require broader interventions. But our scenario is a kind of a soft scenario in the baseline. Now, your second point, some of these shocks are global shocks. They require global interventions. There is no question that global interventions are needed when you have this type of pandemic, and after the pandemic, you have inflation. Inflation is broad-based. There, I think the big question when we think about this global safety net, we know what that global safety net is. The global safety net is going to basically what the IMF is going to bring to the table, what the World Bank is going to bring to the table, what the other development banks going to bring to the table. And it's ultimately global communities' homework to think about how to expand the global safety net. On the part of these institutions owned by the global community, we will execute those decisions to the best of our ability. We will, of course, use the tools we have. We will do our best to have intelligent approaches, new, more flexible financing tools. And it's great that there is now an intensive debate with respect to the, how we can use the bank more effectively, how we can use the fund more effectively when it comes to these more the challenges at the global scale. Obviously, we have been going through a period of persistent shocks that started with the pandemic, then translated into, of course, the inflation, higher interest rates, the food insecurity, and then the war. All of these force us to basically use the financial ammunition we have aggressively. We had record lending during the pandemic, not just 1 year, year after year, because there was a huge surge in demand. Fund does the same. How we can be much more effective when the next crisis comes, we are working on those, and we are optimistic that we have new financing tools, and of course we are going to use our balance sheet even more aggressively, and we are going to bring the kind of the relief our members demand. On the solutions, you mentioned these, swap lines. Of course, those swap lines are much more prevalent now than they used to be, and that's good news. And it's not just swap lines between advanced economies and emerging markets; it's also swap lines within emerging markets. You see these arrangements, and these are all welcome developments. Now, some of these issues you mentioned, relate to medium term and the long term challenges like this, de-risking cost of loans. And there, at the World Bank, we have, of course, our arm MIGA, basically working on this issue intensively. And we are looking into options to expand that facility in the near future. In an environment, you have significant needs when it comes to infrastructure financing, especially in the context of climate change. You need to find new financing, as well as, of course, the innovative ways of financing and blended financing options, the risking, and then, of course, the mobilizing private capital, finding ways to make attractive to invest in emerging developing economies. All of these issues are on the table. Of course, G20, thanks to India's presidency, put these issues on the front burner. And we have been having a very constructive conversation with our members on the evolution roadmap for the World Bank. And we will continue these conversations during the annual meetings. And we have already made some progress, but we will make more progress. Thank you, Ashima, and I look forward to the exchange from colleagues watching us.
Sharon, would you like to ask?
Yes, Professor, you have asked such pertinent questions. I was thinking on similar lines. Ayhan, I know you have been in the thick of things, and I know that you have pondered over it. A quick question. I thought your idea of swap lines between developing countries is a brilliant idea. And I think they need to bail themselves out. One thought I had was, in India, we do not suffer the same situation which the rest of the world is suffering. As Professor mentioned, we have taken care of our international reserves and things like that. But still, our domestic debt is high. And not right now, but there was a time when nearly 1/4 of our budget was preempted by interest payments because of domestic debt. Right? That's the time when I was thinking, like the private sector, can we repay our high cost debt? Because the interest rate cycle keeps moving. Countries have incurred, as you rightly said, during COVID, there was a flash flood of borrowings, and countries have borrowed extensively and at a very high cost. And now when the interest rates will go down and these borrowings are long term, can they repay back? So like the private sector always repays back whenever the interest rate cycle changes. Is there a provision we can think about it? And secondly, as a multilateral agency, can you mediate and to just mitigate the burden between the private creditors and the government, and rather than like bringing it precipitating a restructuring as we have to do in case of Argentina or other countries which finally collapse or declare bankruptcy, maybe before that situation emerges, learning from the past, if and the Brady bonds came in and all that came in, so learning from the past, if we could help these LICs and EMDs by restructuring their loans and asking their creditors to be more humane and not precipitate a crisis. What would you think about this idea?
Do you want to take some more questions, or shall I answer Sharon's question?
Yes, please, Dr. Rekha.
First of all, let me thank Dr. Kose for the very cryptic presentation. It was very interesting for me after attending the 24/7 and around the globe seminar held by SDGs Solution Network headed by Jeffrey Sachs, which predicted that there will be fragmented credit space and greater barriers to trade, which was reaffirmed today. And it is also interesting that for the first time in this seminar, World Bank has announced that there will be deeper recession, almost depression. Here, I would like to draw it will be almost revealing to tell that a lot is happening down south in Karnataka, in the federal finance, in Kerala, and Chennai, Tamil Nadu, more than in Delhi. I would like to draw your attention towards this. In federal finance, regional finance is leading in both debt recovery and economic growth. The second point I would like to make is that the focus on debt recovery, particularly the payment of debt to the World Bank, is likely to be very low. The focus on this is likely to be low because the interest rate component and interest servicing component is quite high, which, as Dr. Charan rightly said, the World Bank has to be more humane in dealing with it. And thirdly, I would like to make the point that the role of private sector, which was not considered in a big way here, but then mentioned very well cryptically, is likely to increase. And the EMDs are very likely to manage their own economic growth with private sector rather than with public finance, that is the pump priming, which is coming towards its limits. Thank you.
So, yes, Dr. Kurian? You are on mute. You have to unmute yourself.
Thank you very much for the excellent presentation. I have 3 points. One is you referred to growth, but we also have some reports on the distribution question. For example, the Paris School of Economics along with growth, then hello?
Yes, so you're not very clear. Seems to be breaking. Your voice seems to be breaking. Can you hear him, Ayhan? Just try again.
Not very clear. Not very clear, Pro.
Maybe if you would like to type your question in the chat. Your voice is breaking. Perhaps you could type your question in the chat. There seems to be some problem in your connection. It's going on and on. Any other questions?
I will be very brief. One is this distribution question, which you did not mention. If we take into that also account, would it be the worst hit, the poorest in the world? And the second is you referred to the borrowing, public borrowing by all the countries in the world. And I understand that USA is the topmost in borrowing. But when we come to the low-income countries, as you referred to, there is a huge interest rate differential between the more developed countries and the less developed countries. How do you explain this contrast? And finally, you referred to the environment question. And there is an emerging powerful school in the world called degrowth. From your presentation, I understand that you are against it, but do you find any logic in this school of degrowth? So these are my 3 questions. Thank you again very much for your very good presentation. Thank you.
Thank you. Now it was clear. So would you like to take up these questions then?
Let me take up these. We are coming to the end. So first, Sharan's question about really it's about debt management, and Sharan knows these issues more than I do. In a perfect world, you want to basically solve problems timely. You don't want to delay the problems. Now, you don't want to try to restructure your debt when there is a gun on your head and your back is against the wall and you are forced to do it. You would like to basically change the maturity structure of the debt. And I think Sharan was talking about this issue. Take advantage of sometimes, of course, the lower interest rates over a longer time period. And you would like to do that with private creditors when you are in a stronger position, not you are in a weaker position. So what happened is that, Sharan, especially in the context of IDA, this is very important because IDA there's a lot of basically grants, concessional loans, but we established this sustainable development financing policy. What we are trying to do, we are trying to improve debt management and debt transparency in IDA countries. So every year we have milestones we would like to check. Every year we basically have conversations with respect to how countries are going to improve their debt transparency and their debt management and fiscal policies overall. In some countries, you don't have good debt recording. Then I go to the extremes. Yet alone, have a good sense of maturity structure of the debt, and then you try to reduce the high cost debt. I'm not going to talk about countries. They have all types of liabilities. You really don't know what they are because there are, the opaque transactions taking place. The issue is that most of the time, unless you have this threat of a crisis, countries are not making enough progress. And this has happened very recently in the context of some countries. We saw the case of, for example, Sri Lanka, not making the kind of the interventions that were necessary to address the fiscal problems that were mounting. And that basically led to the kind of the current very serious debt crisis Sri Lanka has been trying to address and has made some progress recently. So there is no question we need to improve that management. And Sharan, more than anyone else, you need to have capacity on the other side of the table. And that has been a very significant constraint in the context of low-income countries. Let me turn to the points Reka made. Just to clarify, I did not say that there's going to be a deep recession. In the baseline, we are basically seeing global economy slowing relative to last year sharply, but there is no deep recession. And that we looked at some scenarios, the possibility of that outcome. The second point, and I'm going to use the phrase you used, being more human. We have no problem comparing our record with the record of any other IFI when it comes to what we did during the pandemic. We provided more net transfers to emerging developing economies than at any time we did during our history. And this is something, very important to understand. A country might be making payments In the context of low-income countries, the bank is very active, lower middle-income countries as well, providing concessional loans, the grants. We have the IDA arm. So, but that doesn't change one thing. We are still providing transfers to these countries. Ultimately, we need to, of course, provide more financing. There is no question about that. And we are trying to do that. But at the end of the day, we all need to understand one thing. World Bank is not just an institution in isolation. It is owned by the shareholders. And it is ability to do more ultimately determined by its shareholders, global community. So the bank's performance on the lending side, operational side during the pandemic led to this record, the disbursements and record commitments. Now, Matthew, you raised very critical points, the point with respect to distribution. And I'm happy simply answer your question. Yes, during the pandemic, we had one of the worst hits to poverty. Poverty was in a declining trend for more than 2 decades. That trend got disrupted because of the pandemic. And unfortunately, these overlapping crises led to, the recovery fizzling in the context of poverty outcomes. With respect to interest rate differentials, yes, you are right. These differentials are large, especially from the private sector. Okay, this is critical. From the perspective of the bank, when we lend to countries, there is basically for the low-income countries, depending on the country income level, there's adjustment the cost of loans. And for low-income countries, lower middle-income countries, in the context of IDA, we are trying to use, of course, the concessional, the grant facilities. The issue boils down to type of interventions. I think Ashima elegantly articulated how we can de-risk these projects, making sure there's larger funding available at a lower cost, and how we can come up with different types of financing options. And there is a big push to do that. Your third point is degrowth school. The one thing we need to internalize is that we can disagree on many things when it comes to our priorities. Someone might think that our single most important priority is addressing the climate problem. Someone might say, no, it is poverty. It's the most important problem. Someone might say, no, it's income inequality. It's not just poverty or climate. Someone might say, no, we need to address the gender inequality, income inequality. Or when it comes to education, education is the most important problem. But everybody would agree on one thing. There is one solution. We need to invest. We cannot address the problem of climate without investment. We cannot address the problem of poverty without investment. We cannot address the problem of inequality without investment. Other problems as well, we need to invest in health, education. So we need to grow to invest. I think that there is this debate when I think about the richer members of the World Bank versus poorer members of the World Bank. And we need to be careful about talking about giving up growth in an environment we see there are a number of countries out there, their per capita income levels still less than 2% of advanced economy income levels. It's much easier to have these types of statements when we forget there is no problem that's national. Problems increasingly transborder problems. And I think we need to realize that we might think a problem is not our problem, but sooner or later, problems in remote corners of the world basically come to our borders. And there are different reasons that happen. I talked about these social tensions, huge push because of climate change. People are moving from parts of the world that are becoming hotter at a rapid pace to other parts because they don't have the resources to make a living. So we need to, in a sense, think about the solutions before coming up all encompassing observations. Let me turn to Ashima and thank you again for this very good discussion.
Yes, I think that is an excellent, excellent answer. When you have a very low per capita income, you have to grow, it has to rise, but it has to rise in a sustainable way. So overall, a really excellent session. But I just had one question, if I can ask you, this debt resolution, because of China factor, this, they are saying that the Bretton Woods institutions should take a haircut. Is that still an issue or has it been resolved? Because I was thinking that there are MDBs in regional MDBs and they also have this preferred creditor status, which kind of lowers the interest rate they pay and therefore the loan rates they charge. And those are benchmarks for private loans. So does China understand this? That, so that they also benefit from the preferred creditor status that MDBs have. So is that still an issue in the negotiations? One problem in restructuring is that the non-Paris Club China share is very large and they are not coming to the table. Is that still an issue or is it being resolved?
I think China dropped that demand, Ashima. So we move beyond that. The preferred credit status, very, very important. Primarily because at the end of the day, this global safety net is something you need to protect, and it's all about the preferred creditor status, and it is everybody needs that. So you want these institutions to be ready to help and provide net flows into these economies at the lowest cost possible. China dropped that demand, and I think we are at a different point when it comes to resolution of debt challenges. There is still a lot of work to be done, but recent progress has been welcome.
Good. Okay, thank you very much. I don't think there are any other questions, so yeah, I think we can stop here.
Yeah.
Charan, you want to take over?
Yeah, thank you very much. And fascinating, just fascinating. And so much is happening in this world these days. But the philosophical bearings that you brought towards the end of your talk, I totally agree. What are the real life situations when per capita income in many countries is less than 2%? Even in India, we are just around 3%. So I totally agree with you that the situation is very grim and COVID has really pushed us far deeper in the wall. So I must thank you, Ayhan. I know how busy you are. I'm sorry I keep pestering you. I'm very greedy, but the type of research that you bring in, and because I know you so well, I take the liberty of pushing you and saying, "Ayhan, please agree to this and that." And I agree with you that on a Friday morning, we have taken nearly 90 minutes of yours, but you have seen how fruitful they have been. From the interaction, you would see how eager we were to talk to you and listen to you. And the way you handled some of our questions, to me, of course, you reminded many things about debt management. And I really like your answer. Where is the capacity at that side? How do you really do this restructuring? Thought very thoughtful responses to our issues. So I must thank you for that. Professor Ashima is our advisor, and I tap her always at a short notice. I'm sorry, Professor, and I thank you for always obliging and taking over whenever we need you the most. This week, the coming week, we have two excellent sessions. One is continuing from the previous week, where we are struggling with the Russia-Ukraine war and its implications on the global economy. We have two professors coming up on July 20th, little break from our Friday series. July 20th is a Thursday. Professor Barry Eichengreen will probably give us the American view. And then at Berkeley, we have another Professor Yuri, who's a Ukrainian. And we have got him in so that we get the Ukrainian view. And last week we had two ambassadors, one ambassador to Russia, another ambassador to Europe. We had the Russian view and the European view. And then we had one military army general in India. So we had a very different view. To keep the cycle complete, to make the cycle complete, we have invited Barry Eichengreen and Professor Yuri, both from Berkeley, one giving us an American perspective, the other Ukrainian perspective. I would invite you to please join. On Friday, our usual slot, we have another fascinating story from Professor Sam Asher, London Imperial College, and his co-authors have worked on the segregation of people and the implications on their per capita income. So that session will be from 4 to 5:30, and the one on Thursday will be 6 to 7:30. I would invite you to both the sessions and take advantage of the interaction that we would have. And for today, once again, join me in thanking Ayhan Kose and Professor Ashima and other participants who have enriched our discussion. Have a great weekend and look forward to you towards 2 days the next week. One announcement I would like to make: over the years, I have, as an individual, noticed that we economists are we somehow are considered very irrelevant for the world, despite the fact that we run the World Bank, IMF, but somehow we got branded as irrelevant. So EGROW Foundation is offering a course for the non-economists to let them know how important economists are. So the course is titled Economics for Non-Economists. So I would request you to recommend that course. All we are trying to do in that course is to recover some land and say economists at the end of the day are not that bad. So that's all we are attempting in that exercise. It's a 6-hour exercise. We'll do it one hour every day. I would request you to consider, it's on our website, consider popularizing that so that people know that economists have something relevant to share too with the world. So let me conclude and thank you again. Have a great weekend and look forward to you in sitting with us for 2 days next week. Thank you.
Thank you.
Thank you, Sharan. Thank you, Ashima. Nice to meet you all. Sharan,
sir.
hope to see you sooner than later. Bye now.
Thank you.